I'm going to spend about 10 minutes grilling the guys, then I'll throw it open for audience questions, but I get the most fun first. What is the most gruesome failure you've witnessed on your watch?
Why are you looking at me?
You know where the bodies are buried?
Well, this is a little more to do with the pattern of venture capital behavior than it is to startups. Because when you get a successful outcome, which you end up with one startup, the venture capital community being so big and so on top of everything ends up funding 30 to 50 to 100 lookalikes right behind that with this somewhat of the same story. I worked at a firm called Seven Rosen, which back in the day was in telecom equipment and semiconductors and enterprise software and consumer software. We had a very big winner in a company called Sienna, which is still public. We made $1 billion on that investment. And so we funded, I believe, 18 optical switch deals after that. I believe all of them went out of business because that market was capped. And so watching those cash-sucking moths take down all the money and build products that were better in many ways than what the incumbents were doing, but the market had already decided who the winner was a very painful episode for us. And so, it wasn't just one failure, it was many. And for me, I've been in venture for 17 years now, and I've been involved in 100 startups, so unfortunately I have quite a bit of experience in failure mechanisms.
That's pretty good. Can you beat 18, Sandeep?
No, I mean, I spent most of my career wasting my time in graduate school getting my PhD. So, my first deal was an absolute disaster. And this is a semiconductor company which happened to be selling perhaps the best power line communication systems. Unfortunately, it was selling into regulated entities, which are the utilities, in oligopolies or virtual monopolies in the countries or the regions in which they operate. And they had very little incentive to use the magical power of technology to improve the efficiency of their grid or to better serve their customers. I think, and this was a deal we did while I was at Cisco in the investments and acquisitions team a couple of years ago. And at the time, there was a sponsoring executive at Cisco who was absolutely sure that we would work with this company, and worst comes to worst, we'd be sort of the last customer or the investor of last resort. Unfortunately, large companies being as they are, he got reorged away. And at the same time, the regulated entities in Europe decided that they could wait for another 3 years before they actually rolled it out. And I mean, it was just painful to watch the company slowly, unwind itself, and then there was a fire sale at the end. I think, failures are places where you sort of learn, and what I learned is don't sell into oligopolies and don't sell into regulated entities because you can't control markets.
So how many regulated entity startups do we have today?
You're both still being too kind. Those are predominantly extrinsic failures. Those are market failures. The really heart-wrenching ones, the true tragedies where you can have great technology and a great team and still fail because of the market. Let's talk about the ones that could have been avoided. When startups fail for intrinsic reasons, is it the team? Is it the business model? Is it the pricing? Is it the product?
The answer is yes. So I was on the entrepreneurial side before I joined the dark side. I did 3 startups, one of which succeeded, 2 of which failed. So I feel like I have a perspective from both sides of the entity. I think the biggest challenge for us, and I mean everybody here, is that we are all born with cognitive bias. Every one of us has a bias in how we look at things and how we approach things and our attitudes towards things, and especially if it's our own company. So I would say the biggest challenge everybody here has is self-awareness around our cognitive bias on 3 dimensions if you're starting a company or building a company. One is, do you have the correct view of how unfair your advantage is if you're starting a company? Is it slightly better? Is it a lot better? Is it 10x better? Number two, how profound is the customer pain? And what I mean by that is customers often don't tell you the whole truth and don't even know what the whole truth is. They'll tell you they want something when you pitch them the idea. They'll say, yeah, I'll try it. It sounds interesting, it could be great, but they're not telling you whether they're going to buy it. They're not telling you what their agenda is. They're not telling you what's going on internally in their organization, especially if this is a business-to-business idea. And so really being able to characterize how deep the customer pain is has so many facets to it. And the problem is with our biases, we tend to want to select things that confirm our assumptions about why what we're doing is very good and very important. And so we cherry pick, even unconsciously, the good news, and we tend not to look for the bad news when we're doing a customer or opportunity investigation. And then lastly is how easy is it to adopt? If a product is very hard to adopt, if it's very hard to use, or if it's unclear why they're finding it hard to adopt, often our biases look for the positive things that customers say about our product, but we don't really, what I like to say, peel the onion. A customer tries your product, they're getting the top layer of the onion. If the top layer of the onion is confusing, they don't even go to the second layer of the onion or third layer. And so if you're trying to define the product correctly, you're not even getting to the second and third and fourth layers of the onion to figure out whether that product is sellable or not. You know, everyone talks about the MVP. The MVP has to go all the way to the center of the onion. Just having a great UI or a great UX is not enough. It's super important because that's how you get to the next layer of the onion. So understanding that dynamic of am I being really honest with myself and my team about how unfair our advantage is, how profound the pain is of a customer, and whether or not this is easy for them to use, that they'll buy it. That tends to be the biggest sets of mechanisms where we see companies that don't work out.
I think team dynamics are tough as well. To the extent that people have their own biases, you want to have people in a team who are different from each other, but at the same time, you want that conflict to be constructive. And it's often tough especially with entrepreneurs who are very driven, or with technologists who have a particular frame of mind to actually to steer them off course. And this doesn't need to be the investors doing that. Actually, just the team talking to them about it is oftentimes pretty challenging.
It is. Because when you're in an early stage company, and the analogy I use is that we're all looking at a painting. It's a white canvas, and there's a white stripe of paint down the middle of it. And let's all, as a group, assess the value of that painting. Is that worth $30,000, or is that worth not the cost of the materials? And so when it's very early, a product is half-baked, the idea is half-baked, the market understanding of the product is non-existent, and so you're all trying to look at this thing and say, do we see the same thing the same way? And that's where the breakdown can occur.
Should we be aiming for an environment where all startups are above average and everyone gets a trophy, or does failure actually have some real market uses?
Why do you keep looking at me?
I'll go first, Nick. So apart from the fact that we have a fiduciary duty to the people whose money we're deploying, I think that there's a more fundamental reason to actually be truthful and honest to our startups. I don't know how you guys do it in your partnership, but we definitely force rank all our startups. And the reason we do it is so that we know which are the ones that we have to spend more time working with. The ones that are obviously, off to a great start, you don't actually have to do anything. You just go to the board meetings, and you might even have the board meetings over a glass of wine. But the ones, where there are things to be done, you would spend a lot of time outside the board meetings, working with the entrepreneurs, working with partners, potentially hiring, and all of these other things, right? I absolutely think that it's important to, as hard as it is, to be able to call out which of your babies is uglier, so that you can, find a way to fix the problem.
Isn't there a risk inherent in that, though, of sunk cost fallacy, where you're spending all of your time on the failing companies that an investor can't fix because the problems are inherent?
Yes.
The hard part is that from the entrepreneur side, you live in the 16 hours a day. A VC, is not unlike a seagull. It flies by, drops a turd, and then flies off to the next board meeting. And so for you, you're living in this, and you have a relationship with an investor that's maybe now has some friction in it because things aren't going quite to plan. And so how do you together figure out what decisions need to get made, what reallocation of resource needs to happen, where is the diagnostic mistake happening in what's really operating on the company? And the hard part, again, is that you're doing this because you're inherently optimistic. You're doing this because you're inherently confident. And you're builders. Everyone in people in here are builders. And virtually no startup has an unimpeded run to the end zone. Everybody gets blindsided. Everybody falls down. In fact, many of the successes that we all know about and talk about were, in effect, stumbled pivots into something that was working and was not the original thesis for why the company got started and funded in the first place. And so there is a randomness, right time, right place portion of the function of the outcome. I like to think that right time, right place is probably 40% of an outcome. So, and that's the hard thing, is you don't know whether your timing is perfect or whether or not the market needs it right this second. And so much of this is a temporal thing. And so, again, it comes back to intellectual honesty about a single version of the truth about what's operating on the company.
Yep.
Which is a great segue to my next question. Of the factors that are within a founder's control, what are the best practices you've seen for warding off the easy failures, the obvious failures?
Thanks for giving it to me.
For Sandeep. So,
don't run out of money. That would be one.
yes, don't run out of money. Don't commit fraud, which is an easy one as well.
Don't commit crime.
And don't commit crime, I suppose, yes. No, I mean, I think that I like to think about things that I cannot change. So the things that I cannot change are, I cannot change the market. The market is what it is. It's hard to change, actually, the culture of a company as well, because once it gets baked in the early days, it tends to stick around. So those are the two things that you diligence before you go into a deal. The things that you can change or you can help around, I think you can have some influence in the ecosystem of a company, especially with enterprise companies, right? I think that you can help with product and with recruiting and to bolster the team. And you can, in some cases, help with technology, but not a lot. Again, technology, there's a ton of technical debt that gets built up early on. I think the biggest place where VCs can help, actually, is operations, to be honest with you. And the only reason is because we've seen the movie play out so many times with products that work or do not work, that we have you can think of us as consultants who take equity in your company.
Yeah, at the end of the day, we're all pattern recognition engines. Each of us has a set of patterns. And so where there's value from an investor is the more patterns they have, the more they can apply. History doesn't repeat itself, but it does rhyme. And human behavior absolutely repeats itself. And so if you get with an investor that's been in lots and lots of companies, you get the benefit of their scar tissue applied to your situation. But just to take it one step further, I would like to have one discussion topic on something that maybe you think about, which is, when does the relationship between the CEO or the founder and the investor hit a crisis point or a red point with the situation with the company? And I will tell you, I've been doing this a long time, if the founding team sticks and makes it all the way through, the returns to the venture community is 1,000 times better than when we have to replace a founder as a CEO.
Right.
So we are highly incented to make the founding team successful. That said, the demands on a company changes as the company goes through its different stages of evolution.
Right.
And the skill set that started the company is not the skill set that operates the company when it's in its go-to-market phase or when it's in its growth phase. And oftentimes, the founder themselves is in a position where there's a Peter Principle effect and it's gotten beyond their capability. And so we do have to have the conversation about bringing in somebody that can help scale the company. And we do that in what I believe is as an aligned view as possible with making that person rich. But it's a very difficult and painful conversation, and often you get ego clashes that are very painful to repair. and sometimes are unrepairable.
Yep.
But if you take money from an investor, you're in effect giving the company over to the investor, and then they give it back to you when it either sells or goes public. And so there is, you have to understand and appreciate that it's your company and you're building it, but your control of it is somewhat attenuated by the investor group and their shareholder position.
And we are all, founders and investors alike, stewards of other people's money,
Yes.
fundamentally.
Yeah, we've got a bunch of different universities and a bunch of pension funds and retirement money invested in us, and then we give it to you. And so, I feel very, very careful about making sure we're stewards for that money.
I'm going to kick into a bunch of lightning rounds. This is your opportunity to get up and line up your question. Sandeep and Nick, which fails fastest, consumer or enterprise?
Consumer, in my opinion.
Both.
You're not going to be able to wiggle out of
Sorry.
all of them. Hardware or software?
Hardware.
Yeah, although I think these are pendulums that swing back and forth, and so I think, I would not do a semiconductor deal right now, and I would not do an optical switch deal. That said, I think you're going to find a bunch of interesting consumer hardware companies getting built right now.
The trouble is atoms have so much friction. They're
Yes.
really intractable.
Yes.
Too bad, because I had this great semiconductor turnaround company in the future.
Waterfall or agile?
Agile.
Agile fails
fails
faster?
fastest?
I think agile, failed fastest.
Yes, yeah,
Sorry. Waterfall, obviously.
Yeah, I would go with waterfall.
yeah.
But, yeah.
Open source or proprietary?
Oh, dear.
Not answered. Pleading the fifth.
I think the open source business model is very challenging and very difficult, yet open source companies continue to get funded, so they continue to possibly challenge that. I like proprietary because if you're selling to a business, you better have something that either locks in the customer or locks in the shareholder value of the company. And if it's open source, there's just a lot of avenues for leakage in your business model.
Yeah. I think that open source works as a marketing ploy
Yeah, it's
rather
a
than
go-to-market.
It's a go-to-market ploy. It's not you have to build a real product that is affiliated in some way to the funnel
Yes.
advantage that you get from open source. But ultimately, you're making money on the proprietary component of whatever it is that you're selling, either a product or a service.
So I'll raise my hand and say I'm a complete hypocrite because I've funded many open source companies, even though I hate the business model.
The really monster outcomes in open source have all been services. Facebook, Google, AWS, all built on huge open source stacks.
Yep.
Right.
To pivot or not to pivot?
How many times have you heard the word pivot at this conference?
Exactly.
Really? If you keep pivoting, you do a 360, and you're at the same place.
Pivot is to startups what agile is to software development.
Yeah. Pivot is a completely overused, abused, meaningless word. I think for me, all of us here, if we're starting a company, it's a discovery process, and you're running a set of experiments. We give you a chunk of money. You get to run a set of experiments in an elapsed period of time. If you can't discover or learn fast enough, then the thing doesn't go. If you discover or learn fast enough, then you get to collect $200 and play another round. And so that's the game, is an experimentation engine. And so that's the way I tend to think about it.
The fast and the curious. Okay, audience questions.
Hi, Richard Lazar with Techology. We help tech companies deal with the regulatory environment, which you touched on earlier. The regulatory environment, it's important for companies to know what the regulatory environment is, and then in terms of control, things they have control over or not, they can take steps to adapt to the regulatory model. They can try and influence the regulatory model. What are you seeing in terms of regulatory impacts on the notion of failure, which is sort of the theme here? Thanks.
So regulations keep changing with time. We have to be aware of that. At the same time, it takes forever to change regulations. So, I think that we would proceed with a great deal of caution in companies that are looking to buck the commonly understood regulatory framework wherever you are. At the same time, every frontier business that we're discussing, drones or AR or VR, will obviously have regulatory impacts. I think the way you build a startup, at least a lean or agile startup, is to start with the portion of the market that is, least concerned with regulatory impact. So for instance, if I had an AR company that came and told me that, I'm using this AR technology to help fix, complex machinery on the side of the street, that's perhaps easier than saying, I'm going to use AR to actually drill a hole into your heart and use AR as an assistive surgery device, for instance. So there are ways in which you can use the technology, and then you wait for the regulatory environment to sort of mature and accept it. Because I'm practically married to a lawyer, and I can tell you that it's really hard to explain technology to constitutional lawyers.
So practically married, you want to talk about that?
Hey guys, my name is Kartik Ram. Nick, I've known you since
Kartik,
the
how are you?
Belty days. Good, yeah. I run fashionfund.com, which is a design marketplace for entrepreneurs that are successful to get more funding. So companies that are selling on Nordstrom, et cetera. It's, most startups don't ship and they don't make enough money. And during the days of fucked company in the previous bubble, you could read up on these companies that are failing. But
CB
now
Ventures has just basically restarted it, by the way.
Oh, very good, yeah. So what are maybe the top 3 things you would say not to do in the present unit of time? Because clearly the money is drying up.
Yeah.
Clearly incubators and accelerators have overfunded, and there's going to be a Series A, B, and C crunch. So what would you say like the lessons are for anybody going through any level of maturity right now in the startup stage?
That you could do a whole panel on that conversation. Yeah. So I guess the one thing I would say is that the amount of money you raise affects your behavior in many ways. If you raise $1 million, you behave differently than 5 or 10, and your how you think about your assumptions are different. There is an old line, starved rats live longer. And I do believe we're going to move into a starved rats live longer mode for those management teams and founders that know how to manage expense and really can fix or drive their revenue to where the crossover point is much sooner. I think that's a very healthy thing. I think the unicorn phenomena is like an alcoholic saying they're going to go and get help and they just can't stop. And so I think that had to stop. There's a healthy swing back. We have to build businesses that can be funded out of the cash flow from operations, i.e. from customer dollars, not equity dollars. The sooner you get off the equity dollar drug, the sooner you retain ownership in the company. And so this is forcing that behavior. And so I just tell people, when they say we want to raise 50 to 100 million, we just stop the meeting. Because either it's too large a capital project for us, or we can see how the behavior is going to instantiate itself in the outcome.
Hi, Danny Nguyen, MBA student from UC Berkeley. Go BA.
Go on.
So I have a question about the VR space. This is one of the hottest space in the tech industry, and a lot of money pour into it, but there's no clear, revenue model yet. Well, there's some, but not such big as a lot of people think. I would like to hear each of your opinion on the VR space. What do you think, what it is, and what do you think it will be in the next 3 to 5 years?
Has anyone seen the Magic Leap demo yet?
Yeah.
You have? Is it
It's nice.
is it spellbinding?
It's pretty nice.
Is it $1 billion nice?
No comment.
Okay.
Rachel, do you want to take this one?
Yeah, I've been tracking VR for 20 years. That's how old I am. It comes back again and again because the desire for truly immersive experiences is so compelling. We've never had a platform that can deliver it yet. And right now we've got HoloLens and Oculus and Magic Leap and a bunch of other experiments fermenting in the labs. But until we have the hardware, frankly, the platform that brings together all of the content, then you're just going to have a bunch of silos and very little crossover and very little critical mass around the creative community, I think. So jury's still out. Super exciting. I'm looking at everything that comes across my desk.
I just think the challenge with this and with some of the other categories is everyone wants to have the canonical global answer for VR, AR, AI, one of these acronyms. And instead of trying to build a gigantic platform, I think the companies that are focused on solving a very specific problem where they can tailor the hardware and the software and the service around just solving one thing that is extremely painful for customers, I think that's where you'll find the adoption start to take hold.
Which is a really good point. The VR market, the AR market, reminds me enormously of smartphones before the iPhone.
That's right.
And the job of bringing that platform to market is inevitably going to be for a big company because hardware is really hard. The companies that were poised to drop into that iOS environment and build apps profited enormously. But they were very narrow in their ambitions and very focused. So
You're probably too young, you don't remember this, but remember Newton? Right? I mean, Newton is kind of, VR projects writ large, and then Palm Pilot came, and they did an amazing job of narrowing the scope of the product definition, so it just worked in a much narrower use case, instead of trying to bring out a platform. And that really became, obviously, the precursor to the phones you got that you're looking at right now.
great question.
Last question. My name is Matt Day. I'm Managing Director of Founders Floor. We're an accelerator program in downtown San Jose. So although we haven't worked together on any deals or companies right now, as of yet, what is your thought of other accelerator companies for startups, and what do you think do they actually help startups increase the probability for success from what you've seen in some of the deals you've done with others, YC, 500 Startups, AngelPad, Techstars, others?
Take that.
Sure.
They can. It really varies enormously from accelerator to accelerator. There is a law of diminishing returns for sure. As the batches get bigger, the value that startups get out of the program declines. The quality of the mentors, the engagement of the mentors is absolutely critical to the program. But I talk to a lot of startups out of Australia, and my routine advice is try and get yourself into one of these programs because you have to learn the language of investing here in the Valley. And the conversation here is moving so much more rapidly than in any of the regional hubs. It just adds that layer of polish. It's like grad school, especially for startups.
Like finishing school.
Finishing school, that's a really apt metaphor that I'm intending to steal. Thank you very much for your time. We're out of time.
And we'd like
we'll
to
be sticking around for a couple of seconds after, so come and...
please give our panel a big hand. Thank you.
Thank you.